Hello, we're the Team CMU Tepper MBA CQA Investment Challenge 2017 contenders. Today we're going to talk a little bit about the investment team and our background. Then we'll go into what our investment strategy was and how it bled into our portfolio construction. We'll take a look at how that portfolio performed over the time period and then analyze the pros and cons of our choices and do a couple of takeaways at the end. So the investment team, we're 5 full-time MBA Carnegie Mellon students. So I'm Yusuf Ahmed. I'm joined today by my colleague Jake Jolly. Unfortunately, Jeff Luby, Adi Malik, and Corey Morgenthaler all had work, so they weren't able to join us for filming today. We all have a variety of backgrounds. So we have 2 CPAs, 1 CFA, 1 economist, and I used to be a music producer. So for our investment strategy, we decided to employ a multi-factor strategy. The factors that we decided to use were value, momentum, and low volatility. So each of these factors we kind of took away from some financial economist research and what would be a good idea. So for the value premium, we took stocks that have higher expected returns on a risk-adjusted basis than growth stocks, and we used book to market as a proxy. For momentum, we took recent strong performers and kind of assumed that they would continue to perform well. The proxy was for medium-term momentum were 12-month returns minus the previous month's returns, and then short-term reversals was the opposite of the previous month's returns. And then the low volatility stocks, we said that they would have a higher risk-adjusted return than high volatility stocks. And the proxy we used for that were 36-month price volatility. So I'm going to hand it over to Jake to talk about the fact set.
So we did perform a little bit of back testing before selecting these factors. What this chart shows you is the performance of the factors on the Russell 1000, essentially taking the top decile going long and going short the bottom decile. And rebalancing that portfolio every 3 months. So what we see here is basically the very strong performance of the low volatility strategy, the value strategy, as well as short-term reversals. So how do we go about constructing the portfolio? Well, we started with the Russell 1000, our universe obviously, and we converted those proxies into sector-based z-scores. Once we had sector-based z-scores, we did a Windsorization and then weighted to essentially calculate a single z-score for every individual stock, which allowed us to rank sort and take the top 100 z-scores as our long candidates and the bottom 100 as our short candidates. Then we performed a simple linear program to optimize the weighting scheme of the portfolio. This allowed us to achieve the maximum z-score while meeting the constraints of a market neutral portfolio. So obviously getting between the 0.25 and negative 0.25 net beta. The portfolio that we ended up with, the optimized weights was 49 long positions and 49 short positions, and our net beta was a negative 0.2. Unfortunately, the negative beta on our portfolio worked against us during the first month. So here's the performance of the portfolio through essentially the beginning of December. The rally that followed the presidential election, the broader market rally negatively impacted the portfolio given our net negative beta exposure. As you can see here, these are positions that lost more than 7.5%. As you can see, they're almost entirely our short positions. On the long side of the portfolio, we did have 36 names with positive returns, about 73% of our bets. But again, largely outweighed by the short side. Yeah.
So coming into January, as you can see here, our active return started to decline greatly. A lot of this was a result, as Jake just mentioned, of the factor exposure to the Trump bump. Going into kind of the different sensitivity analysis here, we have short-term momentum and medium-term momentum considerably adding value to the portfolio, but unfortunately our volatility play did not play well at all for us. Had we removed the volatility, we would have had a decently performing portfolio with the momentum plays, but it just didn't work out that way. So we decided to rebalance in January, and so we reran our screen on the Russell 1000 with updated proxies, and we basically reduced the portfolio to 25 long, 25 short, and we had a net beta that was positive in this instance. So as you can see here, rebalancing the portfolio with the renewed factors was a good idea. We started to come back. So we regained a lot of the ground that we lost, but having lost this much ground throughout a significant portion of the time period of the competition, it was hard to really regain everything. So as you can see here, the short-term and medium-term momentum they started to come back up because we were able to we refreshed the stale factors that were underlying that. Again, our volatility play did not help us, and there was a conglomeration of a bunch of other factors that bled into all these different factors that we decided to go with.
Yeah, and sort of extending that idea of factors going stale, we show here our exposure to medium-term momentum. So obviously at the beginning, the initial portfolio that we implemented, very high exposure to medium-term momentum. We saw that really played well into our return. That's the blue line that we see here. But our exposure declined over time, essentially because the factor exposure that we had at the beginning became stale. Those securities that had good, strong medium-term momentum became securities that didn't. So really, we would have liked to rebalance back here, but unfortunately, we did not. The plan was always to rebalance at the sort of halfway mark. When we did rebalance in January, you see that our exposure to medium momentum jumps back up, and that does play well for us in January. So really, what are the big lessons that we learned from this investment challenge? Well, the first one is that a market neutral portfolio should in fact be market neutral. Unfortunately, the portfolio that we initially went with was a negative beta portfolio. We were implicitly taking a view on the direction of the market, and that really came back to bite us. So we are quite weary of negative beta tilts, particularly since due to the equity risk premium, markets tend to go up. We also believe and have learned that rebalancing the portfolio more frequently, assuming that it's economically practical given transaction costs, we should have and would have liked to do more rebalancing to make sure that we have the factor exposure that we desire. And then finally, greater diversification. We probably should have touched on this a bit more, but really the portfolio, the return is being negatively impacted by stock-specific factors. I shouldn't call them factors, stock-specific risk, but we feel that we could have avoided some of that negative return by being more diversified, but we were running a fairly concentrated portfolio through the competition. So thank you for your time. We really appreciate the CQA hosting this event. It's been a great learning experience, so thank you very much.